8.1, recording closing entries. We have one learning objective. You need to be able to journalize and post closing entries for a service business organized as a proprietorship. So first they're going to talk about the difference between a permanent and a temporary account. A permanent account is anything that is used to accumulate information from one fiscal period to the next. So we're going to keep track of it. It's going to be an ongoing thing from one fiscal period to the next. They also could be referred to as real accounts. Temporary accounts then are accounts that are used to accumulate information until it's transferred to the owner's capital accounts. So our temporary accounts are those accounts that affect capital, except we want to keep them separate from our capital account because we want to keep track each fiscal period how much we have in those accounts. Okay? Another word for temporary accounts are our nominal accounts. So closing entries are needed to close our temporary accounts. Closing entries are journal entries that are used to prepare those temporary accounts for a new fiscal period, because every fiscal period we want to start those temporary accounts with a zero balance. When revenue is greater than total expenses, this would give us a net income. Our income summary account then would have a credit balance as shown in the T account. So here they're just showing us income summary. If revenue is greater than expenses, we will have a credit balance. When total expenses are greater than revenue, meaning we have a net loss, our income summary then would have a debit balance as shown as in this T account. So in this case, our total expenses is greater, therefore we would have a debit balance. Closing entry for our income statement accounts with a credit balance. So we're going to do 4 closing entries. Our first closing entry is we are going to look at our income statement accounts, and we are going to close any of those accounts that have a credit balance. Oops, sorry. So when we look, our first, well, really our only account that we have right now is our sales account that has a credit balance. So here they're showing us that credit balance of $58.20. Now remember, sales affects our capital account. Okay, but we kept that into a separate account because we want to see how much sales we have for each fiscal period. So this is not an account that we want to keep open every fiscal period, because then we'll see the sales over a full period of time, and we want to see the sales for each fiscal period so that we can compare each fiscal period's sales. So we need to close that account. We need to bring it down to 0 so that we can start our new fiscal period with a 0 balance. Now, if we have a credit balance of $58.20, to close that account to bring it to 0, we would simply need to debit that account for $58.20. Now, in this case, what we're going to remember, we always have to have a credit to go with our debit. So in this case, we're going to use income summary as our account that we're going to close revenue into. So we're just going to put this money, it's almost like we're going to throw this money into our income summary for right now, and then we'll deal with it later. When we put it into our journal, just like we saw with our adjusting entries, we're going to have that heading of closing entries first. Then we're going to put in our date. We're going to put in our debit, so we're debiting sales for $58.20, and we're crediting income summary for $58.20. We do not have a document number here because it is a closing entry. That's why we need to have that heading. Our second closing entry is we're going to close income statement accounts that have a debit balance. So here they give us, this is a nice visual, they give us this, our worksheet, and we're looking at our income statement columns from our worksheet. We are looking at all of those debit ones in our income statement column, debit and income statement debit column. We need to close all of these accounts. So we're going to do that in one transaction. So if we close all of these accounts, meaning we're going to bring them to 0, we're going to credit all of those accounts to do that. To debit then, we are going to debit our income summary. So we're going to start with our date. We're going to write in income summary. Now, I'm not going to put in this debit amount right now because I don't know that debit amount. So we're going to pretend as if this number is hidden right now. We're then going to put in all of our accounts that we are closing, and we're going to credit all of those accounts. The way that I get this income summary debit amount then is I'm going to add up all of these accounts, and that is going to be my one debit to income summary. Again, I do not have a source document here because this is a closing entry. My third closing entry is going to do two things at once. I'm going to be recording my net income or my net loss, depending on what I have. And then at the same time, that is going to end up closing my income summary account. So I'm looking here and I'm looking at my net income. This time I have a net income and I need to record that net income. So this is the way that I look at it. If I have a net income, I know that that is going to increase my owner's capital account. And to increase my owner's capital account, I would need to credit that account because it's on the right side of the equation. It increases on the right. Now, if it was a net loss, that would tell me my owner's capital is going to decrease. And to decrease that capital account, I would debit that account and to decrease it. So this is not always going to be this order. Okay, we're not always going to debit income summary and credit capital. It will depend on if we have a net income or a net loss. If we have a net income, we're crediting capital. If we have a net loss, we would debit capital. Now, this income summary, it ends up closing income summary at the same time that we're recording that net income or net loss. Okay, so we're going to debit income summary, credit capital. Our last closing entry is we need to close our owner's drawing account. So to close our owner's drawing account, we look here at our balance sheet and we see that it is a debit balance. So that tells us that we're going to credit that account to close it. If we're crediting that account, we're going to debit our capital account. Again, if we think of this, drawing is something that will decrease our capital account. And we know to decrease a capital account, we would need to debit that account. And that's what we're doing here. So we'll put in our date, our debit to our capital account, and our credit to our drawing account. Those were our 4 closing entries. So question number 1, what do the ending balances of permanent accounts for one fiscal period represent at the beginning of the next fiscal period? So remember, permanent accounts are those accounts that stay open. So what would their ending balance mean for the beginning of the next fiscal period? That ending balance then of one fiscal period is going to be the beginning balance for the next fiscal period. Number 2, what do the balances of temporary accounts show? They are going to show the changes in the owner's capital account for a single fiscal period. So it's only looking at one fiscal period for those temporary accounts. Number 3, list the 4 closing entries. First, we're going to close the income statement accounts that have credit balances. Next, we're going to close the income statement accounts that have debit balances. Next, we're going to record our net income or our net loss, and that will also then close our income summary. And then our fourth, we're going to close our owner's drawing account. That was the end of an 8-1 lecture. You can now move on to the 8-1 work together and on your own.